Hello guys, welcome to lesson 3 of the course, and on today's lesson we're going to be talking about rejection blocks, and this is going to be an in-depth lesson on what rejection blocks are, how to utilize rejection blocks in trading, and the underlying understanding behind what rejection blocks are. So hopefully you enjoy this video just like the other ones, and we're going to get going. Alright, so the first thing we need to do before we go into what rejection blocks are is we need to define what constitutes one. Now, whenever you look at a candlestick, so I'll do a very crude drawing of what a candlestick looks like. So let's assume this is a bullish candlestick. Alright, so you have the open here of the bullish candle, you have the close, and we're going to define the high of the candlestick. And then the low of the candlestick. Okay, so we have a standard bullish candle here. We have the open of the candle, we have the close of the candle, we have the high of the candle, and then we have the low of the candle. Now if you compare this candle, let's say the asset was British pound. If you compare this candle across different price fields, you're going to see the high is going to vary. Alright, the high is never going to be the same for all the price fields. It's just always going to be variation between the high and the low of the candlestick. Now in interbank terms, whenever we see the wicks of a candle, we view that as the fluff. So when I say fluff, I mean we're not really interested in the wicks of the candle. We're more interested in the body of the candle. Now the question is, why are we interested in the body of the candle? Because the body of the candle is where the bulk of liquidity inside the candlestick is done. So we're going to define this as the bulk of the volume of liquidity. Here, so inside a candlestick, which is utilized for a transactional purpose, the bulk of the volume of liquidity, this is a bullish candle, so that's going to be bullish liquidity. Alright, so the bulk of the volume of that bullish liquidity occurred inside the body of the candlesticks. The wicks of the candle, right, they're not as important as the body of the candlestick. Okay, so hopefully that defines where the bulk of the volume of liquidity occurs. Now if you went back to the previous video where I talked about mitigation block, you will hear me talk about the body of the candle, and also when I talked about other blocks, I also talked about the body of the candle, and I mentioned the bulk of volume being done inside the body of a candle. That's the same thing with rejection block. Now I'm not saying this is a rejection block, okay, but you need to understand why rejection blocks are the way they are. Now going into this is what a rejection block looks like. So now let's go back and define what a rejection block is. So we're going to clear out all of these drawings here, and we're going to define a rejection block. Alright, so a rejection block occurs when we have two candlestick bodies in close proximity to one another, and they create a swing point. Now on subsequent lessons, I think it's gonna be, so let me go through the course outline. On the lesson on institutional swing points, which is lesson number 4 of the high time frame price action study, we're going to talk more on swing points. So I don't want to go in depth on that because we're going to cover this more in detail. What institutional swing points are, professional accumulation distribution, SMT, and all those different things. So it's going to be a very fun video. But going back into rejection block, Whenever we see two candlestick bodies, two opposing candlestick bodies. So when I say two opposing candlestick bodies, I mean for a swing guy, you're looking for a bullish candle and a bearish candle, and then for a swingler, you're looking for a bearish candle and a bullish candle. So whenever you see two candlestick bodies in close proximity to one another and they create a swing point, you've got a rejection block. So let me show you conceptually what they look like. This, all right, so you can see prior to this turning point here, it would have been bullish candles going higher. And when we make the swing point, you have a bullish candle here, and then you have a down candle or a bearish candle here, and then the market starts to trade lower. Now, why is this important to us as institutional traders? Because if the market finds support at discount and we're looking to buy, aiming for a premium, before the market runs for this swing guy here, now this is a swing guy here, it has to go through the rejection blocks first. Now, why does it need to go through the rejection blocks first? Because that's where the bulk of fund level liquidity would be resting at that swing high if they were short. Now, contrary to what you think when people say when we run liquidity in the marketplace, we're running retail liquidity. Retail liquidity, we're not running your liquidity. We're not running the average Joe's liquidity, okay? Like I've mentioned before, they don't even measure up to the liquidity in the marketplace. So whenever we talk about running liquidity, we're always discussing the funds, okay? So that's the liquidity that will rest around these type of levels. Now, when we're down at discount and we're looking to be a buyer, anticipate the market to run and create new highs, the first objective for a liquidity pull is going to be the rejection block. Because a lot of times the market can run up into a rejection block, not get up into a swing high, and then run lower. And that would suffice as a run on liquidity. Now, if you look at retail classic double bottoms, the question is, why do classic double bottoms and double tops in the marketplace occur? Because for the textbooks to write about double tops and double bottoms as a form of high probability strategy, even though it's not, there's some truth to it. Okay, what's going on there at double bottoms is we are running rejection blocks. So we can go and look at any example. Let's see if we can find one. Any example of a double bottom or a double top, and it will make sense. So right here we have what retail will consider a double top, right? The M formation. Now you're gonna look at this, you're gonna think, well, this does not make sense. Isn't this just classic resistance? No, it's not. Look at this. Now, if you were expecting a run on liquidity, this out here, you never get that. So if you're buying down here, assuming this was a bullshit block plus a volume balance, and you're using that to frame a long, and you're hoping for the market to get up into this one guy here before you exited your profits, it never gives you that, and then you get stopped out eventually. Meanwhile, the market was going up into a rejection block. See? And retail goes and thinks that's a double top, but I know that's a run a rejection block. You are not going to value this lesson, but this lesson is really important, because what this does is it lets you understand when equal lows or equal highs should not be taken out. Because you see, a lot of institutional traders, they think every equal highs in the marketplace should be taken out, and every equal lows in the marketplace should be taken out. And you've seen me go into the marketplace and tell you when that's not supposed to happen, and this is one of them, right? So when I see a run on rejection block like this, institutional traders are thinking the market should run above the buy stop. I'm thinking the market should run against sell stop, because we've run liquidity. This is enough for me, because we're bearish. And that brings into putting into context rejection block. Okay, how can you use rejection block in context? Now, if the market runs down to discount and you're buying, you always want to start to scale up partials at a rejection block. Now, if I time from order flow is bullish and you're looking to be bullish and you want to see the market create new highs, then the anticipation is the market should trade through the order block. That's the anticipation. Now, rejection blocks can be used as points of target and also points of reversal. Just the same way you're going to use a short term eye or a swing eye for liquidity, to aim for liquidity, and that swing eye can also be utilized as terms of short. So when I say terms of short, I mean a false break above a short term eye and the market reverses. You can also do that same thing on rejection blocks right here. Now in this example, if I was buying down here, and I'll explain so hopefully it makes sense. So let's assume we have a run on sell stops. This is a breaker block, even though I've not explained what breaker blocks are, but just follow me for a moment, okay? Or let's use a more familiar term. Let's use a bull shutter block. So the market declines down into a bull shutter block. Okay, we have a confluence of a breaker block, bull shutter block there, and I'm buying. If I'm buying here and my stop is below this, the low of this candle, just that bull shutter block, my expectation would be the market should run the rejection block, and when it gets up there, I'm gonna take out 80%. If this one gets what I'm aiming for, I'll take out 80%. Why? Because order flow is clearly bearish, right? You can see order flow clearly is bearish. We're declining, and what I teach you guys is never try to time a long-term reversal in the marketplace. You are going to lose almost every single time. So you never try to time a long-term reversal. You follow the trend. But now we can aim for this. Excuse me. We can aim for this rejection blocks up here, expecting the market to run up there and clear out the liquidity. But in this example, because time from order flow is bearish, I'll take up the bulk of my liquidity up here, because it could run up there and act as a turret and then sell off. Now usually whenever rejection blocks act as points of reversals, it's going to be in confluence with something else. Now sometimes it could be there alone, but what you want to look for, number one, what's order flow? That usually is the first thing. If order flow is bearish and you're buying and your aim is a swing guy there, then you want to take the bulk of your volume at the rejection blocks first, and then see if the market is willing to offer a run up into swing guy there. Then you can take extra partials left. That's the method of approach you're supposed to take. Alright, now if you look to your left, you can see you have a fair value gap. Okay, so you have a rejection block inside the fair value gap. Look at the bodies respecting this. Again, if you're not aware of what fair value gaps are, I'll do a lesson on that. So that's going to be on lesson 6. When we talk about fair valuation, we're going to discuss all the types of inefficiencies in price. So don't worry about that. Okay, so as the market trades up into the rejection block, what's going on there? The bulk of the volume of the funds were shorting euro. Again, remember, the funds, they are trend following. So once the market runs below a short-term low, which is this, again, this is a swing low, you have high, lower candle, higher candle. That's a swing low right there. So the moment the market runs below that daily low, the funds are shorting. If the funds are shorting, you're going to protect your liquidity with the bodies of the candle, because they recognize that as the bulk of the volume. So if the central banks can drive the market up there through the algo, then they can neutralize open float liquidity from the funds who are short. Now you're expecting the market to run up here because you think everyone up into liquidity has to be a swing guy. But I'm teaching you that there are certain instances where the rejection block has a higher probability of being a reversal versus the swing guy there. Now, what you can use to confirm this, and I said I'll do a lesson on what's it called? On institutional swing points. So let's just look at what Eurodollar is doing here. Now, what you can use to confirm this, whenever I see actions like this, is what we call correlated asset divergence. So what I just did was I put up a chart of euro futures, because euro is correlated against pound. If euro is bearish, pound is going to be bearish. If euro is bullish, pound is going to be bullish. If pound is making lower highs, euro is supposed to make lower highs also. But if pound is making lower highs and euro is making higher highs, that is institutional distribution right there. So you can see this is a lower high. Now I'm not looking at the wicks of the candle. Again, I'm not interested in the wicks of the candle. I'm interested in the bodies of the candle. So if we use a line chart which plots the close of the candles, you're going to see at that swing guy there at a premium inside the fair value gap, we have a correlated asset divergence, which is what I call professional distribution, because we're selling shorts. It's called professional distribution. If we're going higher, that will be professional accumulation, but this is professional distribution right there. So you can see that rejection blocks can also be utilized as areas for new order flow, right? So pre-existing order flow was bullish all the way up to here, and then new order flow, once you get up run above the rejection block, switched over to bearishness. You can see the market run above the bodies of the candle and immediately rejects. Now, going back into this example, you can see here again the bodies of the candle does not have to be equal for that to be valid as a rejection block. All they need to do is they need to be in close proximity to one another. That was what the definition of rejection block I gave you guys a few minutes ago. That was the definition of rejection blocks. Alright, so here you can see they're equal. Now I like to see stuff like this, but whenever I see stuff like this, I use the lowest close of the candle as my rejection block. So if you go up here, this is going to be a rejection block here. Now the question is why I'm going to use this down close candle. You can see how it acts as resistance there for lower delivery, and here. Now the question is, why would we not expect the market to trade on here into this rejection block and reverse? Well, let's assume you sold short. So let's see. So you have a fair value gap here, and the market trades up into the fair value gap, and there's also a volume balance there, and you're selling short. So you're selling short into the volume balance plus a bearish shoulder block, and you're aiming for the liquidity below the slope here. How do you scale out your partials? Well, instead of taking out 80%, just like I did in this first example, because I was trading against bearish item from order flow, here I'm going to take more like 60%. Alright, 60% or 50%. And I'll start to watch the willingness in price. I want to aim for that low. So meaning if we trade on closing base below the rejection block, typically we run immediately for the swing low there. Why? Because the market wants to leave this trading range. That's what's going on there. Now on this run higher, we have a trading range from this high down to this low. The market does not want to create new swings in price. Why? Because it's at a premium. How's that a premium? High to low. Take your measurement out, and you can see we're above the equilibrium of the price range. Alright, see, it's at a premium. Because if we run above this high here, then we're going to be trading outside this trading range. Because there's nothing else for us to reference except this rejection block up here. That's a rejection block also. But it would not make sense for the market to trade up into that rejection block because of all of this trading inside of the candle. All of this trading inside of the candle, and then the sudden displacement lower, showing willingness to want to expand out of this range. Right, it's not going to make sense for the market to run above this high up here. So it's going to run internal liquidity. I'm going to talk more on what internal versus external liquidity is. Alright, so the market trades up, runs above the rejection block. But here you can see it runs and it shows a willingness to want to trade through the bodies of the candle. Now, it's not just doing this because it wants to seek fund level liquidity resting below the bodies of the candle. Alright, it wants to create a new trading range. So this is what you call a trading environment, but this is what I call high time frame institutional sponsorship, bearish high time frame institutional sponsorship. You can see it goes lower to create a new trading range because it's following the macros or the fundamentals. That's what it's doing. Right, but here this runs higher. This is manipulation. That's all this was. But this is not manipulation. This is distribution. We're distributing order flow. Okay, so that's why in this example, I'm not going to take the bulk of my profits off here. I'll only take partials, and I'll wait for the market to run below this low here. And it's going to do that very, very fast. Very fast. It should not show any. It should not do something like this. Runs above the body, closes below, and then the next candle fills straight above. It's not going to do stuff like that. That's to run very, very fast. To stop something like this, reach for the sell side. You can see the next candle, it does that immediately. Alright, so that's what rejection blocks are, and that is the importance of rejection blocks. So I can show you a very awesome example. We have one right now on Eurodollar, which is what I was watching today. And you can see this is the liquidity from Asian session. Look at the bodies of the candle. Now, if you were expecting the market to run above the high there, it never really gets above that high there. But again, the bodies of the candle, that's all we need. So if I was buying this as an inefficiency or as a fair value gap, this, if I was buying as a candle trade out into that fair value gap right there, sorry. So if I was buying this run down into fair value gap there, and I was looking to run above this high up here, this is what I'm going to be aiming for, and I'm going to be taking the bulk of my trades off there. Why? Because we've already defined that daily order flow on euro is bearish. Alright, so if daily order flow on euro is bearish, then it will make sense for us to scale out majority of our liquidity or our volume at where the bodies of the candles are going to rest. So if I go out to a 15-minute time frame, you're going to see that is the level there. The bodies of the candle trades up there, trades up in the bodies of the candle, and then rolls over. But now also, if you look to your left, you can see there is also a fair value gap there, just like in the previous example I gave you with British pound right here. Okay, so because we're trading against order flow, it makes sense that this could potentially be a level of reversal as a total sub short. It does not need to trade above the wicks of the candle for it to be a total sub short. So when I say total sub short, I mean it falls from above a short term high and then a reversal, or a stop on, or you guys like to call it stop on, right? So now, because I'm bearish, if I was to be trading this, once I see this run lower and the run below a short term low, automatically I'm looking to short, and we have an old fair value gap here. Again, I'll talk more on fair value gaps, and it'll make sense. We have an old fair value gap there, which also is unfortunately a BPR, and then we have 1, 2. This candle also comes inside of this, so we have a bear shadow block there. So I will short the bear shadow block, and my stop goes above the BPR a little bit, and I am aiming for sell side liquidity. Now this time I'm not aiming for the rejection block because I'm bearish. I'm not trading against order flow, so the anticipation would be the low here, not the rejection block. So once the market trades down there, let's outline the rejection block. So once the market trades down there, it should have no problem getting below the swing low there. So if I see this, I'm not really worried about oh, the market might potentially reverse. I want to see immediately on the next candle follow through on the downside. Now, if the next candle does not follow through on the downside, then I will scale out some partials, and I'll be watching to see the reaction there. Because we're in very close proximity to liquidity, we don't want to see any deeper retracement until we run liquidity. So that's when you know you can have deep retracement back into the range after we run external liquidity. Alright, so hopefully this lesson was insightful. It might not be as insightful as other videos. This was just a lesson on rejection block. And on the next lesson, we're going to talk about basic elements of trade setup, and we're going to talk more on market maker conditioning. And for the reference points I described on the first video, on institution reference point 1, we've not covered yet break blocks. We've not covered fair value gaps. So I think those are the two missing. You guys already know what old highs are and old lows are, but we're going to talk more in that when we get into internal versus external liquidity. I think that's on, let's see if I can find where it's at. Okay, that's going to be in the short-term time frame price action study, lesson 9. We're going to talk more on internal versus external liquidity, and we're going to go into examples using rejection blocks and old highs and old lows as liquidity targets, and how to use them to frame setups. Okay, but for inefficiencies, we're going to talk about them on lesson 6 of this module, where we go into fair valuation, and it's going to be an in-depth lesson. I think it's going to be one of your best lessons in this module. So hope you guys will have an awesome day, and I will catch you guys all on the next video. Be safe.